Hey everyone, it's Griffin here, and as an investor who's now had some skin in the game both in the stock market and real estate market for several years now, I wanted to make a video going over some of my all-time favorite investments and investment vehicles that I see holding in my own portfolios for years down the line to help propel my net worth. The reality is that in today's investment environment, understanding which positions are the best options for your own situation can be tricky, and with hundreds of YouTubers and media outlets such as myself really trying to capture your attention each and every day, I completely understand how the world of investing can be overwhelming. If only there was a no-nonsense video that would clearly outline some great long-term investment positions. Well, luckily you're in the right place, as today we'll be exploring some investment options that I believe will serve as great tools for building wealth over the next 10 to 20 years. That's right, this isn't a get-rich-quick solution. Rather, these are investments that have a proven track record of sustained growth in the past and still show promise of continued growth in the future. So even though it's expected that there will be future bumps and hurdles along the way, let's make that clear. Holding some of these can definitely put chances on your side for financial success. So grab some popcorn, sit back and enjoy today's video. And by the way, if you're interested in shorter form investment content, make sure to follow me over on TikTok. Alright, so as an avid viewer of my channel, I'm sure what comes to mind when seeking out long-term investments. I'll give you a second. That's right, Dogecoin. No, I've definitely made it clear on my channel that outside of reinvesting back into my own business or other private ventures, I believe that some of the best options available for passive long-term growth of investments is with the use of low-cost exchange-traded funds, or ETFs for short. This leads me though to the first long-term ETF investment, which would be a healthcare ETF because, aging population. Healthcare ETFs come in all shapes and sizes though, so I'll be narrowing down on two options that are quite different from each other, but that both offer some tremendous value moving forward. The first one is the Vanguard Healthcare Index ETF, ticker symbol VHT, and this is an ETF that currently holds 502 individual positions, making it somewhat the S&P 500 of healthcare, and therefore provides massive exposure to the American healthcare industry as a whole, which definitely is not shrinking. In fact, the US home healthcare industry is set to follow an exponential growth trend through to 2027, all while in parallel to the population of individuals above 65 years of age set to double to 1.5 billion by 2050. People are simply living longer, and in the Western world at least, birth rates have been steadily declining, all of which means that over the course of the next coming decades, with a growing aging population, there should be an increased demand in healthcare services. So with this in mind, holding a healthcare ETF such as VTI over the next couple of decades is a surefire way to, at the very least, gain exposure to this rapidly growing industry. Top holdings of VTI include industry leaders such as Johnson & Johnson, United Health Group, Thermo Fisher, and Merck, but the fund also provides exposure to each individual facet of healthcare for a more complete overall position. This includes sub-industries such as biotech, equipment manufacturers, managed healthcare, and pharmaceuticals. Overall, considering the low management expense ratio of this ETF at only 0.1%, VTI managed to return investors an average 14.95% return per year over the past 5 years. And since inception back in 2004, we're looking at an average annual return of above 11%, beating average market returns. Now, on the other hand, if you're more interested in a healthcare ETF that focuses more on the innovation side of things, such as researching stem cells, targeted therapeutics, and molecular diagnostic, all of which will help propel the healthcare industry to new heights over the coming decades, another ETF option that I've personally spoken about previously on the channel and hold in my own portfolio is the ARK Genomic Revolution ETF, ticker symbol ARKG. And I know what you're probably thinking, an ARK ETF for a longer term hold. Seems strange considering the amount of volatility that these ETFs have seen over the past year. And yeah, based on the nature of ARK funds seeking to push the boundaries of investment innovation, there definitely is some truth to that. So an ETF like ARKG, for example, definitely holds higher risk and will most likely see higher levels of volatility over the coming years than an alternative healthcare ETF like VTI. But it's actually for this very reason that I view my own position in this ETF as a longer term long-term hold, which will allow me to ride through this volatility and hopefully make it out the other side with hefty returns. I actually made a full video going over my analysis and thesis around the ARKG ETF that I'll put right here, and if you're interested, I'd highly recommend you check out. Some of the main holdings of this fund include stocks that have been hit hard over the past couple of months, such as Teladoc, Pacific Biosciences, and Axis Sciences. But by holding these through an ETF, you're limiting your individual exposure to each. And while periods of short-term volatility are definitely to be expected from an ETF such as this one, an investment in the genomic revolution space is pretty much a bet on the future of healthcare. This was made very clear to me when I was reading the book The Future is Faster Than You Think, which opened my eyes to the possibilities of this space, and I believe that we'll continue seeing massive innovation in this space, followed with increased equity prices. Now, regarding the performance of this fund, even considering massive levels of volatility and even a 25% decline more recently from all-time highs, well, we're still looking at hefty returns when projected out over the longer term, with average returns of 27.2% annually since inception in 2014. Of course, that's not to say that this fund might not underperform moving forward, but nonetheless, we're seeing growth in this space. With that said, this certainly is not an ETF that I would personally consider if I was looking to hold it for less than, say, a 5-year period. And if you're more risk averse, alternatively, you could definitely check out the VTI Healthcare ETF. Moving on to the second long-term investment that I've been doing significantly more research on over the past couple of months, we have an international or emerging markets ETF. Now, recently we've seen quite a bit of action coming out of China, which has obviously negatively impacted the performance of companies like Alibaba, Tencent, and JD. Don't even get me started on Alibaba. So while the emerging market ETF that I personally hold does indeed provide exposure to the Chinese market, well, if you aren't comfortable with this reality, there are other emerging market ETF options that actually leave China out of the mix, like the EMXH ETF, which is the iShares Emerging Market X China ETF. It's important to mention that if you hop on Google and search for the returns of emerging markets over the past several years, well, historically, these have actually underperformed the returns of the American market by a hefty margin. But we're now seeing significantly higher levels of GDP growth in countries like India, the Philippines, China, and Brazil. Now, you might be thinking, didn't we recently cover the fact that the economy and the stocks that operate in said economy aren't necessarily perfectly correlated, and for this reason, they can move independently and separately from each other? And that is definitely true, but actually applies a bit more to the short-term movements of economic growth and shorter-term movements of equity prices in the market. But when projected out over a longer period of time, or several decades, we can see a much stronger correlation between GDP growth and equity value growth, because when the GDP rises, corporate earnings tend to increase, which of course is bullish for stocks. So all of this to say that even though the past performance of emerging market ETFs have significantly underperformed the returns of the American market, always remember that successful investors are always looking for the next best investment opportunity. And while I'll continue to allocate a pretty large portion of my overall portfolio to the American stock market, most likely throughout the entirety of my investment career, well, I'm trying to allocate some more funds to emerging markets in order to try and capture some of this GDP growth that we'll be seeing over the next coming decades. An ETF like the EMXC, for example, exposes you to over 600 individual stocks from companies such as Taiwan, South Korea, India, and Brazil. Again, though, I would only consider holding an ETF such as this one under the narrative of a minimum 10-year hold to allow enough time for the actual equity market to follow suit with the underlying GDP growth. This doesn't happen overnight. I'd like to now take the opportunity to thank today's video sponsor, Skillshare, which is an online learning community for creative individuals who are looking to broaden their skill set through thousands of classes available on their platform, covering topics such as marketing, business analytics, entrepreneurship, web development, and so much more. Skillshare is a platform that is curated for learning, meaning that you will never be subject to watching an ad on the platform. Your attention can be fully focused towards absorbing the information. Now, recently, in the height of summer and with distractions left and right, I've had a pretty hard time finding focus and getting into a flow state when sitting down to do my work. So one class that I recently took to try and eliminate these distractions and increase my productivity was the Focus: How to Double Your Focus and Decrease Distractions course by Brian Bolt. This was a really quick and to the point 45-minute course featuring 9 lessons geared towards helping you decrease distractions and increase your productive focus. But this is just one of the many skills that I've been able to refine on Skillshare over the course of this summer. So if you're interested in learning a new skill and switching things up over the course of the coming months, then make sure to use the link down below to sign up for Skillshare. The first 1,000 subscribers to do so will get access to a free trial to Skillshare's premium membership. Moving on to the third, I guess we could say, category of investment in this case that I plan to hold basically forever during my investment career. It is real estate, which I'm not sure if you can guess from my content on my channel, but I definitely love investing in real estate. Now, of course, I'm heavily invested in physical real estate through multi-family properties. And while I would recommend trying to achieve this at some point down the line, the reality is that throughout this course of time, there are other options available to you to gain exposure to this asset class. Real estate investment trusts, for example, are a great way to gain both exposure to this real asset class while also increasing your portfolio's income. And regardless of how hot the real estate market has been over the past year or so, this ultimately doesn't really matter in the context of today's video, as remember, I'm approaching this from a multi-decade investment outlook. Just like with categories of stocks, there are also categories of REITs, with trusts that focus on either residential, industrial, retail, or any other form of property really. But as a personal preference, I've mostly been focusing on both residential and industrial REITs, or just property in general, I should say, as these are the two sectors that I believe will be experiencing the highest levels of growth over the next coming decades, stemming from a growing population and increasing concentration of people in metropolitan areas. With this in mind, an REIT ETF could therefore be a great option to provide your portfolio with exposure to this asset class, which otherwise might be out of reach. In the US market, a viable option could be the Vanguard Real Estate Index Fund ETF, ticker symbol VNQ, which has a low management expense ratio at only 0.12%, with exposure to over 170 real estate companies spread across multiple facets of real estate. In fact, the residential and industrial sectors account for roughly 25% of this ETF's holdings, and since inception in 2004, even considering the 2008 meltdown, the average annual return for this fund has been just above 9%. So even though individual physical properties do make up a large portion of my overall portfolio, an investment in an REIT such as this one provides me with more exposure to asset classes and real estate classes, I should say, that might otherwise not be accessible. And finally, when speaking about investments for life, which I'll remind you pretty much just means categories of investment vehicles that should continue to prosper over the coming few decades, well, this video would not be complete if I didn't speak about the famous S&P 500, exposing you to America's 500 largest companies. Now, I've had some viewers mention the fact that I speak about the S&P 500 quite a bit, but there's reason for this. The average retail investor, and even fund manager might I add, has a hard time consistently outperforming the average annual returns of the S&P 500 over multiple years, that is. So under this narrative, a long-term hold of an ETF like an S&P 500 ETF is pretty much one of the best options that an average retail investor can choose to include in their portfolio. This is because the S&P 500 is constantly being rebalanced to reflect the current weighted realities of the American stock market. And as history has shown, average returns in the 8% range over an extended period of time is a powerful force. Now, of course, this index is mainly comprised of mega and large cap companies, which over the past couple of years have dramatically increased in relative cost to earnings. So a focus on mid cap and small cap companies that are also showing better value in the current market environment could also be a great option to include in a longer term portfolio. And so this naturally leads me to a total US market ETF, such as VTI offered by Vanguard once again, with a rock bottom management expense ratio of only 0.03%. And rather than gaining exposure exclusively to large cap companies in the S&P 500, VTI has over 3,900 holdings spread out across all industries and size of stock in the market. There really doesn't get more passive than a total US stock market ETF, and as part of a longer term investment strategy, can represent a solid core holding to your portfolio for long-term growth. So there you have it. Those are a handful of investment categories and ETFs that I try to focus on when approaching a 20-year portfolio outlook. And of course, I actively pick and choose stocks that I believe might outperform the returns of the broader market. But it's always nice to remember that funds such as these ones are consistently making it on base and producing results, even if they aren't flashy.
Why do you like him?
Because he gets on base.
Make sure to let me know down below in the comments which positions you hold for a longer term approach to your investing. And if you enjoyed today's video, please take a second to smash the like button. As always, make sure to check out the link down below to open up a Wealthsimple trade account, and you can get $25 for free. Or if you're more interested in opening up a high interest savings account, check out EQ Bank. They have one of the best rates currently available in the Canadian market. Or hey, if you're interested in getting free Bitcoin up to $250, make sure to check out the link over to BlockFi. Plus, if you're newer to stock market investing and really want to get a full grasp on how to navigate the market and create a portfolio suitable for your needs as an investor, then make sure to check out my full stock market investing course. There's a link down below. Finally, check out Skillshare if you're interested in broadening your scope of skills over the coming months. And on that note, thanks for watching today's video. I will see you in the next one.